Hi, everybody. Thanks very much for tuning in for a fresh new episode of our Made for YouTube series. And, we've been focusing on mutual funds, and the topic today is pretty interesting, as is the guest. So, joining me today will be Jinesh Gopani, who's head of equities at Axis AMC. Jinesh, thanks very much for joining in. And, the topic today is very interesting because for one, it's one of the oldest topics that we've been debating, and yet it hasn't lost any relevance, right? So that is large cap versus mid caps in terms of allocation in your portfolio. Now, before we start talking about what it means and how it should be done, for all of those viewers, who are not really sure how large caps and mid caps are classified, just a quick note: large caps now, by SEBI's definition, are the top 100 stocks according to the market capitalization, right? So number 1 to number 100 will be considered large cap. And the next set of stocks, that's 101 to number 250, by market capitalization, will be considered mid cap stocks, right? So now this is a very tight definition. Earlier, there was some scope for people to use discretion and see what they considered large and mid cap. Now the other thing is that this list is not static, right? So this list keeps changing. The change happens every 6 months. So AMFI, which is the Association of the Mutual Funds of India, releases a list, right, every 6 months. And this is done in the first week to actually give out the list of this 100 and the next 150 stocks, right? So the fund managers have to reorient their portfolios according to this list, and they have some time to do that switch over. So now that we know what large caps and mid caps are, the next logical thing is large cap funds and mid cap funds. The large cap funds, naturally, those which invest in large cap stocks, and mid cap funds are those which invest in mid cap stocks primarily. There is scope to add large cap exposure in mid caps and mid cap exposure in large cap. But anyway, that's a very, very technical definition. Suffice to know that the top 100 are large caps, the next 150 are mid caps. So, Jinesh, let's get started. Now that we know what is what, how do we divide allocation between the two? I mean, is it an equal division in a person's portfolio between large cap and mid cap? Is it static? Should it be static? And how does a person change this allocation? What's a good rule of thumb?
Yeah, hi. I think I would say if it depends on the age profile of an investor. Let's say if he's just hypothetically, if he is just 35 years of age, the ability to take risk is higher than let's say a person who is at 50 or 55 years of age. My advice would be, since your ability to take risk is higher, you have many years to invest. I think it is always good to start with, let's say, 30-35% large cap and balance in mid and small cap. And as you grow, the allocation towards large cap should increase, and slowly and steadily the mid cap should reduce. So maybe if you take a 15-year or a 20-year time frame, and if you can reset every 3 years by 10 percentage point, then I think that should be a good way to allocate, because as you would appreciate, at the age of 35, you are raring to go. You want to take a risk. You want to make more money. You want to invest into stories who can really become a multi-bagger stock. And at the age of 55 or 60, you want more compounders. So I think this is the best way to keep on reshuffling the portfolio in between large and mid cap, depending on the age profile. However, if a person is a very, very conservative or a very, very high risk person, then I think 70-30 or 60-40 on a static basis is also good.
And this would be the largest allocation, right? I mean, I'm not even considering right now small cap, thematic, etc., etc. Uh, a large chunk of a person's portfolio is essentially even now large and mid caps, right?
Correct. See, ultimately, the idea of mid cap is to become future large cap. So the 101 stock to 250 stocks, that range, you will get those multi baggers which will become, let's say, large cap over a period of 5-6 years, and that is where the biggest wealth creation happens. And if economy supports in terms of growth, if there is an opportunity for a company to grow in a sector, then there is huge potential for investors to make money. And that is what we have seen over last many years. India is bottom up market. If you can pick and choose some of the stories which are small cap or large cap or let's say mid cap, I think the amount of money you can make is disproportionate. However, you run a risk also. So on a risk adjusted return metric, obviously mid caps would be higher risky. So investors should have that frame of mind. Whereas large cap, ultimately, as the business models mature, they get into a compounding mode, growing at let's say 15, 20 odd percentage and delivering high cash flows and dividends to the investors. So I think, as I said, from the allocation point of view, at the age of 35 or 30, higher mid caps are warranted. But at the age of 55, you go back to large cap because then you want more stable, steady, consistent return rather than becoming a very high beta portfolio.
Okay, Jinesh, if and there's been enough and more data to suggest that the market and the economy are not directly correlated, right? And in any case, we've seen the vaccination drive has picked up, going well across the country. A lot of the macro indicators are showing some form of recovery. Therefore, wouldn't it be better for somebody to take a more tactical allocation to mid caps now? I mean, if going by the logic that a lot of wealth creation will happen when companies move from mid cap to large cap. Therefore, wouldn't a mid cap fund be better to capture that growth? Because by the time they reach the large cap funds, they would have already seen a lot of this growth.
Correct. So you are absolutely right. After coming from the slump of COVID and recovery mode, the expectation of the economy is that this year we should be growing at 14% nominal GDP growth, and going into FY23 and 24, if we have 10 to 11%, let's say nominal GDP growth, then it's a big economic growth we are looking at over a 3-year period. And that is where, as I said, when there is a broad basing of the economy happening, the mid caps tend to do better in terms of growth, in terms of profitability. And large caps, obviously they are steady compounders. They will also play a big role in terms of compounding machine. However, Sumaira, I should add that given the adoption of technology which is happening in the in different companies, even for that matter, large caps are also very good as a bet, because let's say they might be large cap in terms of market cap, but they might not be large enough in that sector. Let me just give you an example. If you take the share of one private sector bank, I will not name the stock, but I'm just saying that private sector bank has just 2% market share in the total assets and liability side of the market, but it is one of the largest market cap in terms of definition. So the opportunity for a company or a bank like that is still like growing at 20-25% for next, let's say, 10 years. So means what more you want, right? So even in that, I would say good quality mid cap funds and good quality large cap funds is what investors should look for, because there is huge opportunity given the penetration level available in India.
No, I take your point entirely, Jinesh. Which brings me to my next question, which is about this whole role of passive, because we've seen the active large caps underperforming. What is the opportunity now in the future? I mean, because if I were to take, say, an index-based ETF or an index fund, I'm also compelled to use the same weightages, right? Now, you said, suppose, for example, private banks. Now, they have a very, low weightage. I mean, even PSUs, which are the flavor of the season, have a very low weightage on an index. So, therefore, I mean, at some point, will this active-passive performance equalize or normalize? And what should be the strategy going ahead, not just judging by what's happened, in the past?
So I think it's a great question. It's a difficult world, I should say. The dumb money comes and goes, and that is where that passive comes into play. However, one thing we should keep in mind that we have not seen the downturn of the passive funds, even in US. It has been a one-way rally for these passive funds over last many years. I should say around 11 to 12 years now. It has been a one-way street for the passive funds. Obviously, because of the cost factor, they have become darlings of the market in US. However, in India, as you would appreciate, the Nifty constituents itself has changed over last 10 years. So there is lot of active, I would say, interest still there on the stocks. And as I said, if some of the mid caps become large cap, they form part of the index. So, uh, frankly, it's very difficult to give you a view that only active will do well or only passives will do well. However, I think one cycle of up and down would really decide the I would say the fate of active and passive. Because see, at the end of the day, passive is what? It's a dumb money, right? It is coming and not seeing any financials. It is just seeing technicals, and it is just money I have to invest. I will invest, whether I invest in good stock, good governed company, or I'm investing in bad governed company. But when the cycle turns, whether that passive would do equally well like active, I have my doubt. Because obviously, see, at the end of the day, markets are slave to fundamentals, right? And the active fund manager still has enough intelligence to ensure that the portfolio doesn't go down when markets are down, and that is where the entire cycle comes into play. So I think we have not yet seen a full cycle of this up and down on the passive side. It has been a one-way street in US, and even in India, you are just seeing that happening. But let's say, God forbid, if there is one more leg of downturn for whatever reason, uh, I'm not taking COVID because it was like one of a black swan event. But generally, if there is a slowdown and things go wrong, that dumb money will just come and sell in the market, and it can impact the stock prices all across. But fundamentally, some stocks might be very good, and they might outshine in that period. So I would say, just let's wait, let the cycle get over. We'll get to know whether active is good or passive is good. But I think there is room for both.
Absolutely. Okay, Jinesh, just a question for all our people who are watching. We hear fund managers talk about this, market cycle very regularly. How do you actually define what is a market cycle? I mean, how does a person know, whether the cycle is towards an end or, what part of the cycle their own fund may be in?
See, I think market cycles are decided by two factors. First is the fundamentals, the economic fundamentals, and its impact on the company's earnings growth. Because at the end of the day, as I said, markets are slaves to earnings. If earnings don't come, if even if that company is blue chip, it will not perform. So at the end of the day, you are giving risk premium to growth while getting into an equity market. Otherwise, I could have invested in fixed deposits or in debt fund if I wanted the normal return, bond yield return or something like that. But I'm investing, I'm taking a risk of equity because I know these companies are growing at a handsome pace, let's say 2x or 3x of GDP, and are delivering return on equities which are higher than the normal returns what you would get in fixed deposits or in bonds. So clearly, the cycles different. I would say sectors have different business cycles. Likewise, markets also go through their own cycles between value, growth. Then there is a stagnation. Then there is again value and growth coming into play. So I think over a period of 5 years, as the business cycles go through one ups and one leg of up and down, you will get to know how the economic cycles also pan out, and hence the market cycle. So obviously, when things are going great on the economy side, the growth comes into play. When things are not going great on the economy side, the value comes into play. So I think we should not get carried away by this near term cycles if you have a 5 to 10 year view, because this cycles comes and go. Most important part is whether those companies are able to survive those business cycles well, economic cycles well, and then do they come out as a winner? So it might be just a time difference, but not a price difference. So at the end of the day, both cycles will work at different point of time. My advice to investors would be have a good allocation across value and growth, both in large cap as well as in mid cap, so that you manage to get returns in the event of a good bull run, and also in you are able to protect your returns in the way down.
Okay, that was actually the question I was coming to. And for those who might not have understood, basically value is, when a fund manager is looking to buy stocks which are underpriced, right? So you're trying to find the value. What does growth mean? Growth means that you're trying to buy stocks which you feel have an above average chance, or to give you outsized returns in the future, right? So that is growth, and blend is a strategy which is combining a bit of both. So, Jinesh, since you mentioned that go for a bit of value and growth on both large cap and mid cap, I want to just understand that how can it be optimized, right? I mean, uh, is this a strategy that would sort of ride you through every market cycle? Therefore, because either value does well or growth does well, and therefore, do you allocate equally to both kind of funds?
Sure. So, Sumaira, when you are investing in the market, you are not investing with one view, right? And you are not seeing the market on a day-to-day basis. As an investor, you should just pick and choose few funds, or if you are doing directly, you pick and choose few sectors or companies, and you just keep on investing on a systematic basis. So you should not put all eggs in one basket. That is what the norm says. And obviously there are good funds who are available, and they do different and they do demonstrate their skills in the depending on the strategies where what they are following. Most important part is investors should know in what they are investing. The problem is investor go with the flow. They try to invest, and then they say it's a casino market. So 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 I think, and I'm talking more on the direct equity side also, that now is the trend, that this is the theme playing out, let me just go and buy this. And then
Yeah.
after let's say 1 month 2 month, when the theme feed, then you again say, Are, this is not the right way to invest in all those stuff. So my advice would be better to be diversified across value and growth stocks. Look with an investment of 10-year horizon. If you really see, most of the good funds would have delivered you 15-16% CAGR tax-free money over last 10-year period. And if you are part of that, the importance of compounding you will get to know only after 10 years. So I think the idea is, don't get swayed by near-term movements of the market. See who are the best guys who are in this business, and then invest proportionately.
Hmm. Okay, fair enough. The other thing, Jinesh, on this topic is that, if I was to have, say, an outsized allocation to large cap funds, which is the traditional view, uh, the problem is that, large caps now are just the top 100 stocks, right? So you have all the large cap funds, which is anyways the largest category. I mean, correct me if I'm wrong, it's what now, almost a 2 lakh crore rupee category. Then you have other, even mid cap funds will have allocation to large cap, flexi cap funds will have allocation to large cap. But so, there is a lot of money chasing large caps. And let's not forget the ETFs, index funds, etc., which is also a near 3 lakh crore rupee category, out of which at least half would be these big indexed funds, right? So is there a fear that there is just too much money going into just the top 100 stocks, and which at some point will also prove to be detrimental?
As I said, Sumera, that the debate on active and passive, right? Uh, as I said, passive is a dumb money. So,
Hmm.
God forbid if things change for bad,
Yeah.
I think that dumb money will just uh, hammer the markets very, very badly. And that is where the concern is always there, that despite, let's say, the company might be a blue chip company, but it will get hammered only because of the passive outflows which happen. And this we have seen over even during the COVID period, right? You had markets crashing down, and that was mainly because of the ETF outflows which happened from the emerging markets. And India also faced, and there was like close to, if I'm
Yeah.
correct, $8 to $10 billion of outflow which happened, and most of it was ETF outflows, because of the fear of COVID. And that led to markets going down by 35% in just 20 or 30 trading sessions. So, see, what this leads to is the bouts of volatility. When you have a dumb money, doesn't know fundamentals, doesn't know technicals, it always leads to huge volatility. And that is what is happening in the market, that unfortunately, the kind of volatility which is being seen is unprecedented. In last, I think after global financial crisis, we have not seen this kind of volatility coming back, and that is because of the ETF outflows and inflows happening without taking into consideration the fundamentals of the market, fundamentals of the economy, or fundamentals of the company. And so, unfortunately, we have to live with that. At the end of the day, if companies are delivering, there will be some buyer at some price. And as companies deliver numbers, so our job, frankly, is just to concentrate on fundamentals. I cannot do anything on the volatility side, because that is part and parcel of your day-to-day job now, in terms of the market, the way markets are volatile. But just ensuring that you are in the best of the best names, both in mid cap and small cap, and in large cap, which doesn't cut you, and where there is no permanent loss of wealth.
Hmm. Fair enough. Well said, Jinesh. Thanks very much for joining in and for explaining this whole, should I get a large cap? Should I get a mid cap? Should I get both? How much? I mean, I think those are questions that investors will want to keep answering as, we get new investors who join the market. This is, of course, the first question that everyone wants to have answered. So thanks very much for helping us answer
Thank
it.
you. Pleasure. Thank you.
Many things. Thank you. All right, everybody watching, thank you so much. I hope this has been helpful for you. We look forward to hearing all of your comments. So do send them in if you have questions or requests for topics. We'll be happy to take that up too. For now, thanks very much for watching. Bye-bye.